I'm Aaron Merrill with the Mercatus Center, where our mission is to take academic ideas and apply them to real-world policy solutions using a very rigorous economic lens. To that end, today we have, once again, one of our senior research fellows, Dr. Jason Fichtner. His research comes at tax reform from a lot of different angles. His past experience, he was a acting deputy commissioner for Social Security over at the Social Security Administration. And before that, he was a senior economist with the JEC, where he had extensive experience with taxation. He's going to share all of that expertise with you today. So please help me welcome Dr. Jason Fichtner.
Thanks, Aaron. So good afternoon, everyone. Thanks for coming today. To show solidarity with congressional staff, I decided not to wear a suit and enjoy the recess like the rest of you. Although I see one gentleman still is in a suit, so I feel for you. So part of what we're doing today, we're going through, of course, is principles of tax reform, which will, since we're going through a lot right now with deficit reduction, talking about balanced budgets, debt ceiling, spending, tax reform, trying to wrap it all in. How do we sort of look at various proposals and some principles of tax reform? And I also want to spend some time not just on principles, but sort of how the media and various interest groups try to sway public opinion about taxes. We've all sort of seen going on the last few days, whether it's statements from President Obama, from various think tanks or advocacy groups about the rich aren't paying their fair share, or these people aren't paying enough, or corporations are dodging taxes. What does that all mean, and how do we actually evaluate tax reform plans to take all this into account? So we'll talk a little bit about equity and kind of walk through some sort of demonstrations about how this stuff is used to sway public opinion, which you might get calls on or see in the news. So before we start going through sort of taxes, sort of the question is, how did we get here? And this is straight from the Congressional Budget Office. It's a quick chart that shows sort of historically and a little bit of a projection of where we're coming in on revenues and where we are on outlays. And two quick things to note. One, on revenues, there's a long-term historical average since World War II that revenues tend to come in right around 18% of GDP. So sort of regardless of what the tax rates are, regardless of the base, the economy seems to adjust so that we pay about 18% of GDP in revenues. And that sort of means if you raise rates too high, people adjust by paying less. If you raise rates too low, they might pay more, but there's only so much you can actually do. And what basically tends to happen is no matter what we do, we have this sort of natural currency where we seem to level around 18%. And when we've gotten above it, there have been calls for tax cuts. When we've gotten below it, there have been calls for tax increases. So it sort of seems to follow this general equilibrium. Spending at a World War II level sort of goes right around 21% of GDP. If we go above that, that sort of seems to reduce economic growth. You can see in times below, we've changed it and sort of moved back up again. So these some long-term averages we sort of need to pay attention to, because when you look at spending plans that are going through the hill right now, some call for reducing outlays to 20%, some 21, some go as high as 24 or 25. So again, this is the Congressional Budget Office of deficits and surpluses. And yes, for a time being, we did have surpluses. If you guys remember back in 2000, we had surpluses as far as the eye could see. We were concerned the federal government was going to have too much money in surpluses and not sure where to put it. And instead of paying down debt, we decided to put through tax reductions. And then you had a recession, and we had deficits. So we had a few recessions, but now we're basically at the point where we have deficits as far as the eye can see, and wish we had that problem of having surpluses as far as the eye can see. But the point is now, what do we do to get back there? Do we raise taxes? Do we cut spending? Do we do a combination of both? That's sort of what we're leading to with the discussion. This sort of shows a breakout of how different revenues are as a percentage of GDP. And one of the important things is our main one, of course, is individual income taxation. This is the total, but individuals are our primary source of how the federal government brings in revenues. Social insurance, payroll taxes, kind of consistent but gone up. Corporate taxes are low, and excise taxes are low as a share of GDP. So again, the primary thing we talk about tax reform really is looking at individual income taxes. And while there's a lot of discussion on corporate taxes, the share of corporate taxes as a share of GDP has been going down for a variety of reasons. Not because of low profits, because there have been a lot of tax incentives by the tax code to basically move money overseas or to minimize taxes, and corporations have found ways to sort of use the tax code to reduce their tax payments. So now we're sort of talking about the idea of taxes. So what you don't know will cost you money. And I literally mean you guys. It'll cost you money because you're taxpayers as well. And this is one of my favorite comics that came out when we were going through the Bush-Gore tax debates during the Bush-Gore election, which basically has Homer Simpson, represented by the middle class, waving around $2, and actually that $2 is important, and a good old Montgomery Burns, going sucker, representing the rich. And this, again, was sort of portrayed, if you can think back to the Bush elections when it was Bush versus Gore. President Bush, then candidate Bush, came out with a tax plan to reduce marginal rates, reduce taxes on capital gains and dividends. And candidate Gore, then Vice President Gore, said that was just a tax cut for the rich. It wouldn't benefit anybody at all. And candidate Bush came back and said, no, it benefits all taxpayers. And this is the cartoon that started really picked up in the media, that the middle class was getting screwed. So thinking of this in mind, how do we as economists and policy analysts, how do we evaluate tax policy? So there's a few things, of course, to realize sort of stepping back. Why is tax policy at first even important? Right? For one thing, it raises revenue for the government. But the other thing, too, is it affects sort of everything we do when you think about the economy. What we tax, why we tax it, how much, whether we tax tobacco taxes more than other things, sin taxes on alcohol, whether we want to tax income higher than capital gains, whether we give deductions or credits for ethanol. So taxes really affect a lot of incentives and behavior that affect our entire economy and affect the way we sort of behave. We sort of tax marriage differently than we do single people. Sometimes we get a marriage bonus for those who are single earners in a married couple. Sometimes we penalize those that are two earners. That affects incentives to get married and have kids and a lot of other things. What do we use for the main tools to evaluate tax policy? So the first one is we use macroeconomic effects. So everyone's always questioning, what happens if we lower taxes? If we lower taxes, will that increase economic output? If we increase taxes, will that lower economic output? Will it put us back into a recession? So economists look at sort of the change in taxes and try to figure out how that actually affects the macro economy, basically GDP. We also look at revenue tables. The idea is from a purported change in tax policy, how much money are we going to get? Or if we have a tax cut, how much will we lose? If we reduce taxes, could we actually increase revenue? And the point here is not to get into discussion of the Laffer curve, but you can get a general idea that if we had tax rates at 0, we get no revenue. And if we had taxes at 100%, we'd also get no revenue because no one would go to work if they were taxed at 100%. Somewhere in between, you can lower taxes and raise revenues. Someplace you can raise them and raise revenues. It all depends on where you are on the curve and what taxes you are. But economists look at this and try to figure out how people will change their behavior based on a change in taxes and figure out what the revenue gain or loss is accordingly. The third thing we look at is tax distribution tables. And these are the ones that sort of get into fairness and purport to show who wins or loses from a change in tax policy, sort of based on income. So a table would say for those in the 0 to 10,000 range or 10 to 20, they'd see an average tax cut of $300. Or the top 1% would see a tax increase of $1,000. These are what tax distribution tables purport to show, and we'll talk about those more later. So how do we further sort of evaluate tax policies? We look at three measures. One is efficiency, the other is simplicity, and the last one is equity or fairness. Now the first two are kind of straightforward. Efficiency generally tends to mean, do we raise the most amount of revenue without distorting behavior or incentives? So for example, if we tax everyone a poll tax, $10 a head, you're not going to change the fact that you're alive to avoid the tax. But if we start taxing other things, so for example, what if we tax everyone who wore a blue shirt here today? I'd raise a certain amount of revenue, but the next time we had an event, no one would wear a blue shirt. So it wouldn't be a very efficient tax. So again, how do we actually have a proper tax system that raises the most amount of revenue without changing behaviors? The second one is simplicity. We have an issue right now with our current tax code being too complex. Over half the people that file an individual return use a paid preparer. So if it's that simple, people wouldn't use paid preparers. It's kind of complex. It's hard to figure out. So complexity goes with not only time to actually file a return or prepare a return, but also in basically making sure that you comply with the tax laws throughout the year. How is it easy to know? Is it easy to know whether or not you're complying with the tax laws, what to report? All those measures go into the idea of complexity. Do you know how to write off deductions? Do you know how to do depreciation? All those kind of things go into the idea of a complex tax code, or the flip side is simplicity. Lastly is the idea of equity or fairness. This one is sort of the most subjective. We always hear the idea of that's not a fair tax system, that one's not equitable to this group over another. And this is where a lot of times tax debates get hung down, is it really gets focused on equity. Because a lot of times we can agree what's efficient or what's not efficient. We seem to now be at a focus point where a lot of people no longer think the corporate tax code is efficient because it's driving businesses and jobs overseas and job creation. It's also driving corporations to incorporate overseas. And they're using a lot of resources to try to minimize taxes through accountants and lawyers than focusing on business development. So now we have sort of a consensus that complexity is a problem, but we're still not sure whether or not that's a fair issue. So what is fairness? So we kind of look at three things in fairness: horizontal, vertical, and generational equity. So let's take the idea of, first of all, horizontal equity, which is across groups. And the idea there is that we figure that people who have like incomes and like circumstances will pay like amount of taxes. So if we all in this room basically had $100,000 of income as our salary, we had nothing else, we'd all expect to pay the same taxes. That's the idea. We violate it and we start having preferences in the tax code. Say, for example, half the room on the right owned a home and half on the left didn't and rented, but the ones on the right had a home mortgage interest deduction. They could write off that interest where someone who's renting could not, and then this people pay now less taxes. So you sort of violated horizontal equity. On the vertical scale, because of a progressive tax system, we tend to think that people who earn more should pay more in taxes. Not only just nominally, but also as a percent of income. So we have a progressive tax code in our country where the rates are gradually increased on a marginal basis. That's sort of vertical equity. But again, you can violate it in the same way. You can have someone who, again, takes deductions for the home mortgage interest, who claims a lot of deductions for a large mortgaged house that is making more income than someone below them who rents, but ends up paying less in taxes. The other thing to worry about is generational equity. And a lot of times we don't focus on generational equity enough, but we're starting to look more into it when it comes to Social Security taxation. So again, with Social Security, we pay payroll taxes today for those who are the current beneficiaries, with sort of the understanding that tomorrow someone will be working to pay for us. But now think about the idea of reform. What happens if we say we're going to hold everyone who's 55 or older harmless on any reform plan for Social Security? We're just not going to touch them. But for those 55 and younger, we're going to raise the retirement age, and we're also going to raise the payroll tax. That kind of violates generational equity because people today are not going to pay more and get less for it when they retire. So we've got to start considering generational equity issues as well as vertical and horizontal. It's also just to realize point of payment versus incidence. So point of payment is kind of simple. It's who writes the check to the IRS, where incidence means who's actually bearing the burden of the tax. So a great example is hopefully you all filed your tax returns on time by yesterday. As individuals paying the individual tax, you are the point of payment, you write the check to the IRS, you also bear the burden of the income tax. Now let's take a little bit of a different example. You go to the grocery store or you go to a convenience store and you buy a candy bar. You pay a sales tax. In the district, it's 10%. The business is the one who actually writes the check to the IRS for that 10% sales tax, but who bears the burden of it? You do as the consumers. So the incidence of the sales tax actually falls on you, not the person who's writing the check. So it's important to realize where the incidence is versus point of payment, because it's not always the same, and it also affects differences in how we look at taxes and incentives for changing behavior. A direct versus indirect tax, generally there's two ways to look at this. One is a direct tax is the one that you actually write directly to the revenue agent. So like the individual income tax is a direct tax. Some would say a corporate tax is direct because they're sending a check directly to the IRS, where indirect is like a sales tax that's collected for you and then passed on. But economists have started looking at this a little bit differently and started looking at the incidence of the tax to describe a direct or indirect tax, and whether or not you can shift the incidence. So for example, on an individual income tax, again, you guys pay it, you bear the burden, it's a direct tax. You can't shift the burden of that tax to somebody else. A sales tax, however, you can. The corporate tax, even though it's a direct tax in some ways because the corporation writes the check to the IRS and they're the ones paying it, the corporations don't really bear the burden for the tax. It's passed along to consumers or workers. So the new attitude is looking at this in a way of saying maybe an indirect tax is if you can shift the burden of the tax to somebody else, it's indirect tax. If you can't shift the burden, it's a direct tax. It's important to look at marginal rates versus effective, because this will come out a lot of times in debates. Effective tax rates are basically saying what is your average rate. That is, you take all the taxes that you paid over your income, what's the average, that's your effective tax rate. But the margin is what you pay on the next additional dollar. And economists are always concerned about what happens at the margin, because that's where we make decisions about behavior. So for example, I may have an average tax rate of 30%, but my marginal rate could be 40% or 50% if I start adding in state and local taxes and payroll taxes. And at the margin then, that next dollar, if I'm being taxed at 50%, am I going to want to take on additional labor, or am I going to want to do leisure instead? So this comes into a lot of play when you look at households who have a second earner, a spouse who wants to go back to work. They look at the marginal rate, whether or not it's worth it for them to go back based on the taxes, not the effective rate, but the marginal rate. It's also important to look at inclusive rates versus exclusive. This becomes more important when we start talking about national retail sales taxes. And if you look back a few years ago, we started having a discussion about what would the tax rate have to be if we got rid of the individual income tax altogether and just tax consumption. And there was an argument about, oh, you need 23% or you'd need 30%. And they were going back and forth. Turns out both answers were right. So for example, let's take a retail sales tax. You're taxing a candy bar. And let's say we were going to have a $1 candy bar, and I was going to tax you at a 23% rate for that candy bar. What would your total amount of cash do when you bought your candy bar? $1.23. All right? Now think about that $1.23 transaction. What is 23 cents, the tax, of the total transaction of $1.23? It's 30%. So you had various sides playing off the inclusive versus exclusive to try to say whether or not a tax was actually higher or lower to try to sway public opinion. A 20% rate sounds a lot lower than a 30% rate. Now you have the idea of what's the tax base and wider base, lower rates. We hear this a lot now going on with Paul Ryan's plan to basically reduce taxes. And one of the things he wants to do is get rid of a lot of the loopholes in the tax code. And he wants to do this by broadening the base and lowering the tax rates. So think about the idea if we want to collect a certain amount of revenue. And a certain amount of revenue, we're taxing income, capital gains, dividends, rent, everything else that comes into it. And we have a 10% rate. If we start giving more exclusions, and we start giving, we're going to not tax capital gains at a certain rate, we're going to tax them lower. We're not going to tax home mortgage interest reduction, we move that lower. We have to then raise the rate higher to get the same amount of revenue. So what we're trying to do now is the idea, can we lower the marginal tax rates and broaden the base to get rid of some inefficiencies in the tax code, but still raise nearly the same amount of revenue? Another idea to talk about here is, when we talk about the tax base, is what is income? So another question is, what do we want to tax? Not just what are we giving exclusions to, but how do we define what the income is? So most people here, again, just filed your tax returns. A lot of us think about income as adjusted gross income. That's what's on the tax return, which basically includes what you get from wages, what you get from interest, capital gains, dividends. If you rent out your apartment or a condo, you get rent coming in. That's all considered income. There are other measures which we're going to talk about later which look at other expanded things. Do you want to include rent foregone because you're a homeowner? So back in the Clinton days, they had a measure of income called the family economic income, which tried to measure your ability to consume and change in consumption from one year to the next. And they included owner-occupied housing as an income measure. And the idea there was if you were owning your home and not renting it, the difference between what you paid in mortgage and what you could have rented your house for was considered income, and they imputed that to your income level. And there are some folks who say that that's a tax exclusion that we're now giving that we should tax. And I'll show you when we get to the end about tax exclusions how this is actually computed in. Let's also understand, of course, social policy. We do a lot of things in the tax code to encourage certain behavior. We can give deductions for IRAs, so people will save now for their future retirement. We can give deductions for home mortgage interest to encourage home buying. We can do a deduction for employers on their side for health care. We don't tax the premiums on health care coverage for employees on the employer side or the employee side. So we try to do some social policy. Again, we tax tobacco, we tax alcohol. The idea is taxing sin taxes to try to reduce that sort of consumption. Taxes, of course, distort behavior. This is sort of obvious. Again, if I started taxing blue shirts, people with blue shirts would stop showing up here for these Mercatus lunches. If we start taxing labor too high, folks shift income and shift the sources they get income from. We're seeing a lot of things. So when we started raising taxes on labor, employers started shifting to more non-tax compensation. Again, for example, healthcare. So one of the things we're seeing now with the healthcare debate still going on is the idea of Cadillac plans. A lot of employers were giving more generous healthcare compensation plans than they were in wages because that wasn't taxable to the employee or the employer. Now, this is sort of the one principle I sort of want to get across. If you walk away from your day and you only remember one thing, it's that only people can pay taxes. And this means living people, not dead people. So kind of walk through this. Again, the individual income tax, it makes sense. You're working, you're paying the tax, you're writing the check. Think about a corporation. A corporation is not a person. It is a thing. It's an entity. If you raise a tax on a corporation, what happens? All right? One of three things happens with the incidence. So the incidence basically falls on one of three measures. One, it can fall on consumers. In other words, you raise a tax on a corporation, they could raise their prices to cover it. The second thing is it can fall on workers. They could say, hey, you raise our taxes, we're going to reduce the amount of wages we pay our workers or not give them a big enough raise. So workers bear the tax. The third is the owners of capital. Again, a corporation is not a person, it's a thing, but some person owns it. So you can see a reduction in the return to capital either in the form of lower capital gains, lower dividends, or a lower return on that asset. So in some way, shape, or form, all taxes have to be borne by living people. Think about the estate tax. Right? The estate tax, they always say it only falls on the top 2% of estates. Well, what does that mean? Does a dead person pay a tax anymore? No, it falls on the heirs, a living person. So again, only people can pay taxes. When you hear the idea that corporations aren't paying their fair share, what does that mean? Corporations aren't a people. So they're saying people aren't paying their fair share. Or those who are somehow bear the burden aren't paying their fair share. But it depends on how that burden falls. So this is where we start talking about distribution tables. And we're going to start seeing these again a lot more in the press. We start about tax reform. And this is, I will admit, I made this table up on purpose. So this table is designed to give an illustration which just purports to show an income range, where you are basically in the 10 to 20,000 range, 20 to 30, all the way down to 200,000 or more in all taxpayers. It shows the change in federal taxes. So basically, with a tax cut, what would the change be for each group in millions? What would that percent be as a reduction? And it looks at their effective rate, both under the current law and with a proposed change, and then starts about an average tax cut. So this is a tax cut plan that I just created for illustration to show that under my plan, those making $10,000 or less, we get a $300 tax cut on average, $10 to $2,400, all the way down to those making $200,000 or more would get a $5,000 tax cut. The average for all taxpayers would be $650. This is basically a simple reduction that follows through where everyone would pay less than they were paying before. So in my mind, this is fair. Everyone pays less, no one pays more. It's a fair tax plan. Now, some may argue that's not fair. You're giving the wealthy a much larger reduction than you are the poor. And maybe that's not fair at all. So we start arguing about equity. So now we get into the idea of how these are used in the media. So I apologize for the quality of the graphic, but these were actual graphics used, again, sort of during the Bush-Gore debates. And they're actually illustrative of what happens when you use the sort of same information to draw two different sides of a coin. So the first one was done by the Citizens for Tax Justice, which is a labor-backed advocacy group. And they put out something that basically showed that under the Bush plan, the majority of the taxes would go for those in the top 1%. And they used that information to sort of say the tax reduction that President Bush or candidate Bush then wanted to do was unfair. Candidate Bush came back and said, wait a minute. They put something in the Wall Street Journal that said, if you look at our plan, as a share of federal taxes paid, so of all the money collected, the wealthy will pay more as a total share after than before. Now, they're still getting a tax cut, but they're going to be paying more of a share afterwards. Now, how is that possible? Because the lower income groups, those in the very bottom, actually don't pay taxes. Right now, about 45 to 47% of households, according to the Tax Policy Center, don't have a positive tax liability. Under then candidate's Bush plan, they expanded the earned income tax credit and the child tax credit to make it more refundable, which gave more of a transfer back to those lower groups. So in some ways, you were giving a tax cut to those who weren't paying taxes. You were shifting the distribution more up the scale to the higher income groups, even though they were getting a tax cut. So the question is then, what was fair? So this came out in the New York Times, and they went through and said, let's look at the income groups, the change in income taxes, and the share of the overall reduction in taxes, to try to say, well, they're getting more of the tax cuts, but again, the poor are getting a larger percent change in their taxes paid. So this sort of changes your perspective, again, on what is fair. If you just look at the idea of what's the average tax cut someone's getting, anything right now, because of half the tax returns aren't paying any income tax, will look skewed to the rich. There's no way around it. We can't do tax reform without having it look that way unless we start taxing those who aren't paying any taxes. So this is how we're going to start seeing things come out. We've already seen it in the last few days, where we've heard the top 2% are paying the lowest amount they've paid in decades, when in actuality their share of federal income taxes is the highest it's been in decades. So two sides of the same coin using the same data. So sort of walk through again. This is an actual table that was put out by the Joint Committee on Taxation. It was done in 1999, again, going into the Bush-Gore elections. And the reason I like this is because we have a candidate who was running for office who then, when he became elected, basically implemented the exact same plan. So we can see it before and after. And what you see here is the Joint Committee on Taxation estimated that under then candidate's plan, which was HR 2488, those in the under 10,000, we're going to see $36 million reduction in taxes, 0.5%. And there's that $2 tax cut that Homer Simpson was holding up in the cartoon. This became the focal point of all the media discussion on the Bush tax plan, that the poor were going to get $2 while the wealthy were going to get a $2,000 tax cut. This became the entire debate, nothing else. So this is a real table. I didn't make it up, but I cut away some columns. Let's add some columns back in. So this is what you've seen already before. Now let's add a little bit more measures to see whether this is an actual fair tax plan. Under then the current present law, you can see that those in the 10,000 or less are paying $7 billion in taxes, or 0.4% of the total 100. On the proposal, they'd still pay 0.47, but now go down and see who's paying more or less, and you end up getting the point where the wealthy are paying a little bit more of the share of federal taxes afterwards. And the effective tax rate for everybody declines. And this is where candidate Bush, and then President Bush, as he's putting through his plan when he was elected, started saying that this was a fair tax plan because everybody who was paying taxes was going to get less, and everyone was going to have a lower average or effective tax rate than before. Now, yes, the ones at the lower end are going to get $2, but they weren't paying taxes to begin with. Those at the end were going to get $2,000, but they're paying all the taxes, so how do you avoid it? So this is how the debate sort of changed when you added more information. But again, most of the times the media is just going to show you this. They're not going to expand and show you the rest of the data. This is where we get to the idea now, again, of how people don't pay taxes. So the Tax Policy Center came out and said 45 to 47%. This is sort of consistent. The Joint Committee on Taxation has done similar numbers that shows that roughly 50 million households do not pay taxes. It means they have a zero tax liability, or they're getting refundable credits that offsets their tax liability, and in some cases even offsets their payroll taxes they're paying in. So this is where you start seeing that, and it goes through the entire income class. It's not just those that are less than 10,000 that don't pay income taxes. There are some at the higher income levels that find a way to gain deductions and exemptions to also not pay taxes as well. But generally, the majority of it, of course, is at the lower income levels. Basically, those making less than $33,000 or $34,000 a year. This now leads into, of course, who's paying the current share of taxes. So the top 1%, this is based on tax returns, so it's not families or households, it's returns, which could be a single filer or a married couple filing jointly, a joint return. But the top 1% right now is paying 38% of all the federal income taxes. The top 5% are paying 58%. The top 10 pay 78%. The top half are paying 97%, which means, again, the bottom half is only paying 2.7%. How do we actually make the rich pay more of a fair share when they're already paying 38%? And the top half is already paying 97%. Can we do any more than that? And that's one of the questions. The other thing, too, is, well, who is this? So you hear sort of the rhetoric going on recently. A lot of folks say, well, this is just the millionaires and billionaires who've made off generously from the last economic boom. They've got the Bush tax cuts. They're sitting fat and happy. They're CEOs. Let's tax them. This is rich people. Let's not worry about it. But as you'll see now, this really isn't just the rich. The top 10%, you need an AGI, basically about $114,000. So think about being in D.C., a high-cost living area, 2 GS-11 federal employees, right, married, would be rich. The average Washington salary for federal employees is about $71,000 to $75,000. You have 2 feds married together, you get about $140,000, $150,000. Those folks might be in the top 5% of earners in this country. So the point here is when we start talking about the idea of taxing the rich, who are we actually talking about taxing? It's the middle class. And when we mean middle class, we don't mean statistical middle, because the statistical middle is $33,000. If you make less than $33,000 adjusted gross income in your tax return, you're in the bottom half of the income earners in the country. But if you go out and poll people, poll your boss's constituents, most folks are going to tell you that they're middle class. And middle class in this country is very wide. It includes those who are statistically poor and those who are statistically rich. But most of us consider us to be middle class. And President Obama has focused on $250,000 being sort of the cutoff for what he wants to tax. That'd be somewhere around the top 2% of people. But again, the top one's already paying 38%. And you say, well, what are they getting as income? Are they paying a fair share of taxes based on their income? Well, the top 1% report 20% of the income, but pay 38% of the taxes. Again, the top 5 are getting 35% of the income, paying almost 60% of taxes. The top 10% are reporting about 46% of adjusted gross income, and again, paying 70% of the taxes. Go down to the bottom. Yes, the bottom half, this is not where all the money lies, obviously. They're only reporting about 13% of adjusted gross income, but again, only paying less than 3% of taxes. So one of the things that's happened in our tax policy over the last 10, 15 years is we've taken more and more people off the tax rolls. And part of this was also done by the Republicans and President Bush by increasing the child tax credit and the refundable nature of the EITC and the child tax credit. More people started getting a subsidy, stopped paying federal income taxes. And of course, if you're not paying taxes to the government, what is the cost of government to you? What's the cost of expanding it? 0. So when you're not paying taxes, you now see the cost of it being 0, you actually advocate for more and more government. So this sort of the point here is, how are we going to have tax reform if we don't increase taxes on those who are already paying a large burden already? So back in 2005, President Bush convened a tax reform panel and asked them to do 2 things. Develop a few proposals for which we might start seeing being recycled again, because again, there's no new ideas in Washington, just old ones recycled. Try to keep things distributionally neutral. So again, you weren't giving more to the rich or making the poor pay they were already. And try to make it revenue neutral. So they were very constrained in this, but they came up with a few ideas. So this was a look at the tax burden in 2000 and 2005. This is just actual based on the tax reform panel's data using IRS and Treasury data. Then they went forward and said, let's use this to develop a baseline. Basically, the lowest quintile, bottom 20%, are paying 0.4% of taxes. The second quintile is paying 2.4%. The third quintile, 8.5%. 18.5%, and then the highest quintile, again, paying about 70%. They use this as their baseline to measure all various proposals to reform the tax code, from income taxes to a flat tax to a sales tax. So how does this look? Let me walk through. I want to give you some ideas. This was the distribution of various flat tax proposals. And again, our baseline was 0.4 for the lowest quintile. Under a flat tax, which basically would say all income is taxed at one level, whether it's 20%, 21%. I think here it was 20%. The lowest quintile pay 0.7% of all federal taxes, where the highest quintile pay 64%, so they'd go down. Now, a complaint about the flat tax is that there was no deductions for those at lower incomes. So the idea is, what if we modified the flat tax? What if we said, look, we realize that for those in lower incomes who don't want to raise their taxes, we'll exclude the first $20,000, for example, of income from taxation, and then after that, everything will be taxed at 20%. That's a modified flat tax. Now you can see that the tax rate, the share of taxes go down for the lowest quintile and the second quintile and rise a little bit. This one is pretty much distributionally neutral to the current law, a modified flat tax that exempts $20,000 to $24,000 of income from being taxed. The rest is taxed at a flat rate. Yes?
Would it be $40K for married couples or just?
You could do that, yeah. You double it. That's a good point, yes. And the next one to do is, well, people say, well, we have the home mortgage introduction. We don't want to get rid of that and cause a housing crash again. So they said, what if we did a modified flat tax? So again, we're going to exempt a certain amount of income, but we're also going to allow certain top tax expenditures, which is like the home mortgage introduction. And again, going back to our point that if we shrink the base, we now have to raise the rates. This basically not only raised the rates a little bit, but also did the distribution of income. And now you basically have the higher income groups, again, paying a higher share of taxes than before. And the middle class keeps their generous home mortgage introduction, which they rely on so much now today. So that's how sort of a flat tax looks if you have tax expenditures. And the Deficit Commission came out with something similar. The Erskine-Bowles Commission that came out, the President's Bipartisan Fiscal Commission, had a tax reform plan that basically reduced rates, broadened the base, and said, we're going to start with a zero policy. If we have no tax exclusions whatsoever, what would those low rates be? And they gave you 3 low rates and said, but now if you want to add back in some tax expenditures and basically reduce the base, you've got to increase the rates. And they went and said what those rates would have to be to show the trade-off, which I think is a very fair way of showing the trade-offs we have to make if we want to have these tax expenditures by raising rates. We've also talked a lot about a retail sales tax. Now, one of the main complaints you hear about a sales tax is it's very regressive on the poor, that the poor spend more of their income on consumption than the rich do, and hence they would bear a greater burden of that tax than the rich. And that's a fair critique. So what the committee came up with, the bipartisan reform plan back in 2000, was what was called a prebate, which says we'll take the IRS, instead of being tax collectors, we'll make them give out tax rebates instead. So let's take the idea of consumption. Let's say our family of 4 was $20,000. Whatever we decided was the poverty level we wanted to exempt, we would exempt that level from taxation. And instead of having to figure out who was who when you go to the grocery store, the IRS would send a check to everyone either at the beginning of the year or the end of the year to rebate them that money they would have spent on consumption. So say, for example, we had a national retail tax rate that was 10%, and we wanted to exclude the first $20,000 of consumption from tax. At a 10% rate, that's $2,000. Everyone would get a $2,000 check from the IRS. You can do it at the beginning of the year as a prebate to prepay that consumption tax, which the poor do, or you can give it at the end of the year. The argument was made to give it at the beginning of the year, so you basically help those who are at lower income with some consumption. What you'll notice is that, again, 0.4 is our baseline for the lowest quintile. Under a sales tax with prebate, they actually pay a negative 2.5%. What we were finding when they were doing the analysis is there were a lot of people that were spending less than or earned less than that amount of consumption. So we'd be giving them a positive transfer. So they'd come out basically with a positive transfer and come out ahead under this new tax plan than they were under an income tax. So again, if we do some sort of prebate to hold the poor harmless at a certain income level, a national retail sales tax would actually benefit those lower off and roughly keep, again, 70 was our baseline, the same distribution of taxes paid nationally, and get rid of all the negative incentives that come around with taxing income as opposed to consumption. So this goes into how we sort of design tax policy and how we design tables to influence debates. And one is AGI versus FEI. So again, we talk about the idea of adjusted gross income. We all know what that means we see in our tax return. You will see still today, some people put in disclaimers at the bottom of their, I'm going to go back real quick. When we talked about distribution tables, there was a disclaimer down here that had a footnote about what was included in income, how taxes are being determined. Some groups today will actually still expand the income concept to exclude things again like owner-occupied, the imputed rent from owner-occupied housing. What that does is it seems to make everyone wealthier than they are. And if you're someone who on the outside in the public looking in, you're trying to find out where you are on this tax table. If all of a sudden someone's expanded the income concept to include more income than you're used to seeing, if you think you're making $50,000, you're now making 60 or 65. You're thinking the tax cut would benefit somebody who makes more than you when it's actually benefiting you. So it's designed to sort of mislead people, even though some economists think it's better. For politics purposes, it's actually done to mislead. So it's important to sort of figure out when looking at these tables, what's the income measure? If it's more than just a cash income or just a gross income, someone's probably putting stuff in there to try to mislead you. So it's important to ask that question. It's also important we show those tax tables that I sort of took out the columns from joint tax. What's being included in the analysis? If they're just focusing on the average tax cut amount, again, the general idea is they're probably trying to show you that the tax cut's considered quote-unquote unfair and the rich are overly benefiting from the tax cut. They're just showing average tax cut. On the flip side, if someone just shows you tax shares and nothing else, you could say, again, the Bush tax cuts increased the tax shares on the rich. They're paying more. Well, they're paying more of a share of total, but they're still paying less in taxes. So the idea is you need to have a combined look and use these combined measures to really evaluate how a tax policy is affecting equity. It's important to know, again, rates versus base. You could have a high marginal tax rate on a very low base. You could have a high marginal tax rate on a wider base. Makes a big difference in not only revenue collected, but incentives and behaviors. Generally, economists want to see lower rates and a broader tax base. The idea there is we put a lot of inefficiencies in the tax code of behavior when we start limiting what items are taxed and give preferential treatment to taxation. So the more things we can tax at a lower level, the better off we are. Again, assumptions of tax incidence. This is going to get important to the idea of corporate tax. If someone keeps saying that corporations don't pay their fair tax, the question is, well, who's actually paying that tax? The corporation writes the check, but who bears the burden? Some groups will actually look at this and say, we're going to pass on all the burden to workers in the form of lower wages. Some may say, no, we'll pass it on to consumers in the form of higher prices, and then you look at the consumption pattern and see who bears it. Some may say it falls all on those who own capital. So the Joint Committee on Taxation has looked at this over the last 20 years, and they've punted. They say it depends on the tax, depends on the rates, depends on the elasticity of the various products you're looking at. So when the Joint Committee on Taxation does their assumptions of incidence for corporate tax, they split it 1/3, 1/3, 1/3, with 1/3 of the incidence going to workers, 1/3 going to consumers, and 1/3 going to the owners of capital, which at least is intellectually honest. If you say you don't know, we'll split it 1 of 3 ways. What they don't do is say that the corporation bears the burden, which is the important thing to note. And again, before we go on, what's the one key thing to remember? Only people can pay taxes. Exactly. So this is sort of the main thing, but we have some time, and I want to go into a little bit on tax expenditures. And I apologize for all the heavy text, but we're hearing a lot now about the idea of, again, expanding the base by getting rid of various tax expenditures and exclusions. What do we mean by that? What's going on, and why are they called tax expenditures? Why do some folks consider them spending in the tax code as opposed to taxes in general? So the important thing here is tax expenditures essentially operate like direct expenditures, where even though they appear as tax breaks, they benefit hundreds of different types of activities and individuals, and they currently account for about 1/4 or 1/3 of all benefits and subsidies granted to the public. And an idea to think about this is, think about something in the tax code that you could do instead as a direct spending program. The home mortgage introduction is a great example. Instead of giving people a deduction for the home mortgage interest, we could have the housing department of HUD, Housing and Development, give out checks to those who buy houses. We could subsidize housing through a direct subsidy that way as opposed to the tax code. So the idea here is you're sort of masking spending by putting in the tax code. And this is where you have now various reform plans trying to say, let's get rid of this, lower the rates instead, and maybe either get rid of the deductions altogether or make them into credits. Another sort of definition, though, some people say is it's anything that goes against or deviates from what's called the normal income tax. Now, the question is, what do we consider a normal income tax? And it changes depending on who's doing the analysis and what administration is in power. So the Congressional Budget Act of '74 requires that the budget that's submitted to Congress actually include estimates of tax expenditures. So OMB does estimates, the Joint Committee on Taxation does estimates, sometimes you'll see GAO do estimates, CBO will do some, and they don't always match because they have different definitions. So this, and I know it's very hard to see, I apologize, but this is taken directly from President Obama's FY12 budget submission. So I have the link so you can go pull up the table. This is just part of the table. But what I want to point out is what they consider to be tax expenditures and how much this is actually, quote unquote, costing the government. So the first two are sort of the ones that are sort of straightforward. The exclusion for employer contributions to medical insurance premiums. Again, your employer, federal government, or whether you work for the private sector, if they provide you health care or pay part of your premiums, that's a tax deduction on the employer side, and it's not a taxable benefit to the employee. They could tax that. Because they don't tax that as compensation or tax it as wages, there's about $184 billion that's not being taxed or being raised as taxation. The second one is deductibility for mortgage interest on owner-occupied houses. So again, those who claim interest deductions, if we didn't have that, they'd presumably pay higher taxes at around $100 billion or $98 billion a year. Now, sort of go down a little bit further to the fifth one. This is where you get to the exclusion of net imputed rental income. So what does that mean? What is net imputed rental income? Do we give a deduction for rental income? Sometimes yes, but some is owner-occupied housing. So we got to the FEI concept. If they actually taxed sort of the benefit you're getting on your mortgage instead of renting it, they could bring in some extra money. Now let's go down a little bit further, and there's also something that's interesting too. 4 from the bottom is the graduated corporate income tax rate using a normal tax method. So apparently by having a graduated corporate income tax, that's considered a tax expenditure. Some people consider that the graduated income tax we have on individuals is also a tax expenditure. If you look through here, you'll also find that there's a tax expenditure for capital gains being taxed differently than income. Now again, capital gains and dividends are actually taxed twice, once as income and then again as savings. So a lot of economists argue that the ideal tax rate should be 0. But if you don't tax it the same as ordinary income, some people claim it's a tax expenditure. So when we talk about getting rid of tax expenditures, what are we actually talking about? Some things, again, home mortgage interest and employer-provided health care, most economists agree that's a tax expenditure. Things like capital gains and graduated tax rates, we disagree on whether that's a tax expenditure. So it's important to realize what they're talking about when they say we could raise $1 trillion by getting rid of tax expenditures. Well, from where and on whom? So this is sort of a count of tax expenditures. And you can sort of see that, generally speaking, it's been sort of constant, but it goes up. And these are basically considered to be sort of preferences in the tax code and part of the system where people lobby Congress for certain exemptions in the tax code to exclude one thing or the other. So we had a reform, of course, back in 1986. And the 86 Act actually did drop some of the tax preferences just a little bit, but new ones came back. So although old ones didn't return, new ones kept in their service. So you took one tax break away, someone came back and lobbied for another. So we still have a lot of problems with tax expenditures in our current tax code. What are they doing as far as costs? These are 5-year intervals to show the total amount in billions of dollars. And again, these are nominal, but it's showing that they're really increasing over a period where more and more people are finding ways to use tax expenditures to reduce their taxes. So whether or not you believe in what is a tax expenditure, they're still costing the government revenue in some sense or form, which if we got rid of them, we could lower the rates for everybody. So now quickly we go in and I'll sort of wrap up and take some questions. What kind of principles do we want to look at when looking at tax reform? We talked about the idea of fairness, equity, simplicity, complexity, horizontal versus vertical equity, making sure we talk about generational equity. So the perceived fairness promotes system abuse. So one of the things you look at sort of other countries and even in the US, when people think other people are getting away with something, they don't think the tax system's fair. So the perception if CEOs are getting away with not paying their fair share, other folks may not want to pay their share as well, and it can actually lead to tax abuse. So you sort of find is when there's a perceived measure of fairness, voluntary compliance is actually higher. When there's perceived unfairness, voluntary compliance is lower, and that goes into whether or not we think the tax system is, of course, fair and how we want to change it. Higher tax rates do encourage avoidance and evasion. Key terms here, avoidance is legally using the tax system to avoid paying taxes. Evasion is illegally not paying taxes. So for example, through various means, you could use your corporate income tax to move money overseas, do transfer pricing. That's legal avoidance of paying tax. Evasion is not reporting tax altogether, and that's illegal. Bad tax systems chase investors away. The US has now one of the highest corporate tax rates in the OECD, and we're starting to see development and jobs move overseas. Profits that are overseas are remaining overseas. Bad taxes, not just in the US, but internationally, discourage investment. So when we think about the idea of reforming our tax system, we need to have a good system that encourages investment in the US, that's simple, easy to understand, and doesn't discourage saving, investment, or work. And again, that's what good tax systems do. They invest jobs. So we've seen countries abroad that have lowered their tax rates, broadened their base, made it more business and worker friendly, and that's actually led to job creation and more revenues. So those are some of the principles that, again, incentives really matter. We should keep in mind that tax reform should fix the problem. So what I mean by this is someone can talk about the idea of having tax reform where we had the '86 Reform Act, where we lowered rates and broadened the base, but all of a sudden we let the incentives still remain for people to come up and lobby for more tax expenditures. So now that we had an '86 Reform Act, which was generally considered to be at the time successful, we're now here 25 years later looking at the same problem all over again. Policy positions should be based on clearly articulated principles. What are we trying to do with our tax code? Are we just trying to raise revenue? Are we trying to encourage social engineering? Do we want to encourage marriage or discourage it? What are we trying to do? And you hear a lot now with reforms of the tax plan, and there aren't always well-articulated principles for the reform. You hear some. People say we want to have lower corporate tax rate and reduce the corporate burden to increase corporate competitiveness and improve jobs. That's a principle. What are we doing on the individual side? You really don't hear this that often. Are we trying to encourage saving and investing? Are we trying to encourage consumption? Are we trying to discourage debt financing? What do we want to do? Once we know those principles, we can design a tax system for it. The validity of each of these decisions will, of course, be checked against the principles we set forth. Long-term solutions are superior to short-term fixes. So we should not just be looking at the idea of trying to fix a budget problem for today. We need to look out tomorrow, 5 years, 10 years, even beyond that. So one of the problems we've had with looking at a budget when it's over a 10-year period is sometimes a lot of the costs happen outside the 10-year period. We need to make sure that whatever reforms you do really take place and hold us in place for the long term. The best results come from fixing everything at the same time. This is based on international experience, where countries who have started tweaking the tax system, doing one thing here or there, hasn't led to lasting reform. Where if you reform everything at once and get everything out of the way at one time, people have a chance to adjust to it. That makes for a longer lasting and more permanent tax solution. And again, the one thing to remember, everyone pays taxes. Or only people pay taxes, not corporations, not dead people, only living people. With that, I thank you for your time, and I'll take any questions you might have. Yes, sir.
So these might be a little bit tangential, but I was wondering if you could talk a little bit about user fees, like gas taxes that pay for highways, and how you can segregate them from general fund revenues, and also with respect to general funds, what your thoughts are on Pigouvian taxes or sin taxes or whatever you want to call them.
So one of the ideas about having sort of dedicated taxes, like for gas taxes, is you look at the idea, one of the principles of taxation is, do you want to have the ability to pay principle, which means those who make more pay more, or the benefit principle, which says for those who are getting the benefit, they should pay for it. So taxes for like roads and gas taxes, the idea is designed on the benefit principle. If you're the one driving the car, you're the one using the roads, you should pay for it. You do that through the gasoline tax. And assuming there's no hybrids on the road, everyone sort of pays the same miles per gallon and basically has the same mile usage, you will pay more in taxes the more you drive because you're paying and consuming more gas. So I think those are actually a good way to sort of segue and say, how do we have development resources? We want to segue things off away from general revenues and have something for investments, for infrastructure. Then taxes on gasoline make sense, and I think those can be supported and even increased in some cases if you want to have a direct tie for principles. And so a Pigouvian tax is basically the idea of what do you do to try to tax an externality, whether you can get a carbon tax, for example, if you want to reduce carbon emissions. And this is an economist way of trying to find ways to use the market-based incentive to sort of account for externalities or negatives, non-benefits that are being passed on. So a good example for Pigouvian tax is the cap and trade debate going on. If we have sort of the idea of pollution is a bad thing, polluters out there are basically passing on pollution to those who aren't consuming the good of the product, how do you account for that externality? You could tax carbon and use that as a tradable permit to sort of reduce the emissions and also then use the revenues from that to offset some of the externalities. So in general, I'm fine with the idea of pigouvian taxes as long as you can figure out who's actually paying for it. And not only that, but say we have a tax and cap and do a carbon emissions and trading. If the government gets the money, do we know that money is going to go for offsetting pollution? We're not sure. So how do you track where it goes is another important point to consider. Yes?
Quick question with your expenditure.
Quick question about your expenditures chart. It makes it seem, for the past couple of years, it's gotten a little out of hand. But wouldn't you also kind of argue that it's a little misleading because a lot of people wouldn't do the certain activities that is an expenditure write-off if they didn't get the write-off?
Yeah, no, that's a good point. So the idea, let me get back to it. This one, right? Yeah. So the idea here is because people now know there's certain expenditures, are they taking advantage of it? And the answer is, looking at the home mortgage interest deduction, one of the complaints has been that we're subsidizing larger, more expensive homes or second homes. So if we didn't have that, or if we limited it, say we didn't allow second homes to be included, this actual value, that's a good point. So it is in some ways, it's a real value, but you could bring it down by having certain more exclusions to it and limitability. Does that make sense? Yeah. Yes, ma'am. Sorry.
Are we talking about the imputed rental income for individuals and the mortgage interest deduction? Why is nobody talking about for businesses? Businesses purchase property and write off all the interest. They purchase personal property and write off all the interest. This is opposed to renting either the real estate or the personal property. It's the same principle.
I think some people are talking about the idea of how they actually reform the corporate tax code to get rid of a lot of these deductions so they can lower the rates. And that's where you get to the idea.
Well, I haven't seen any of them mentioning getting rid of the interest deduction for corporations.
Well, I think a lot of it's because people don't understand, they're so focused on the individual code, they don't even understand the corporate code enough to talk about it. So what you've heard, if you look at the corporate reform plans that are out, they really are short on details. They basically use, we will lower the rates and broaden the base to improve corporate competitiveness. That's sort of the tagline. And then you write and say, well, what are the details? And they don't have the details. And what you sort of assume is that at some point in the process, when they go through the legislative process, they'll actually come out with details of how they're going to do this. We don't know yet. And that's a good point to bring up is a lot of these plans we've seen so far don't offer up the details to know how we're going to get there. So even on, like, for example, the FY12 budget resolution, Paul Ryan's plan, he said he's going to consolidate the rates. Right now there are currently 6 individual tax rates. He wants to consolidate them. To what number, I don't know, but it should be less than 6. He also wants to have the highest marginal rate being 25%. At what income level? I don't know. Apparently that'll come out in the process. So this is where, and I think you're right to bring up the question of what things are we talking about getting rid of on the exemption side in order to lower rates effectively. And it hasn't come out in the details yet. Yes, sir.
The elimination of the corporate taxes. Has anyone quantified how do we do that, or what would we do with the taxes, what would we do to the revenue stream, or what percentage of the consumers would take the burden, what percentage of investors would take the burden? I mean, the details in doing something like that is how to get there.
Yeah, and then a lot of that still is open for debate. So again, on the assumption of the incidence, the Joint Committee on Taxation punts. They just say 1/3, 1/3, 1/3. But you could sort of see how, in the long run, say you did a tax on soda. So you raise the tax on soda. In a competitive market, that tax would all be passed on to the consumers. Other things may not be the case. So the thing is, where are we taxing and how do we get there is a good point. And what they're most looking at is they're not looking at trying to get rid of the corporate income tax. They're trying to figure out how they actually can reduce the rates to the point where they're more competitive against our trading partners. And that can be done by sort of, again, getting rid of some of these expenditure items in the corporate tax code. Ethanol is a good example. Do you want to have a subsidy for ethanol consumption and ethanol production? That could be one that's gone. If you get rid of that, you can lower tax rates. So they're trying to figure out the trade-offs of what has to go and what things do we give up to lower the rates. But again, a lot of times the details aren't yet available. You just hear the tagline, lower rates, broader base, fairer economy, grow corporate tax revenue that way and create jobs without knowing the details. But the details are important, but until they come out, it's hard to actually sort of talk about what those would be. Anybody else?
You might have sort of already answered this already, but when people are talking, I understand the expenditures and how there's disagreement over exactly what those are, but when people talk about loopholes, it seems like maybe they're talking about the corporate tax, deductions and stuff like that, and there's been a lot made of, and I wanted the same disagreement over what's a loophole and what's not, because Like there's a lot been made of this overseas income exemption for like U.S. multinationals, I think. And my understanding is that that may exist because that's the way other countries treat their own multinationals that have operations here, for example.
So it's a good point to bring up. The U.S. has what's called a worldwide system of taxation. A lot of our trading partners have what's called a territorial. So the United States wants to tax you as individuals or corporations on all money you earn throughout the world. So if you were working in the United Kingdom, they want to tax you that income too. Our trading partners basically have territorial systems where they exclude, and a lot of them have value-added taxes. They rebate the VAT for exports. We don't do that. We don't have that kind of system. So a lot of times what we're seeing when we have the exclusion for deferral, it's called, for U.S. corporations that have an income overseas, we tax it when they bring it back, so they don't bring it back. So they keep it there. So what's been happening is you've seen various proposals every 5, 6, 7 years to actually have a lower tax rate on to bring it back as a revenue raiser. Encourage corporations to keep money overseas until the U.S. lowers it on a temporary basis and then brings it back. We did this a few years ago. We said if we'll lower rates, I think it was to 3 or 4% on income that was deferred, as long as it was brought back and used to create jobs. And what does that mean? You bring money back and invest it, that's particularly to create jobs. So it's the incentives in the tax code, and our corporate system is one where because corporations have the ability to put money overseas, they do so. And they move investment overseas. And a lot of times we're seeing corporations now incorporate and start businesses overseas instead of starting it here. And that does get a question of, is that considered a loophole or an expenditure? But what does a loophole mean? It means you're doing something legally to avoid paying taxes. So because we have all these loopholes or expenditures, again, we don't want to basically encourage corporations to spend more of their time trying to find ways to dodge taxes. We want to encourage them to find more ways to create and grow their business. So this is where we're basically getting a consensus. I was at a Ways and Means hearing about 3 weeks ago where Representative Charlie Rangel started arguing that we need to lower our rates and broaden the base for the corporate taxes. And it was sort of this epiphany now, okay, we all agree, let's just do it. But the point is, how do you get there? And the biggest problem is as soon as we start taking away one subsidy, someone complains. So a great example is where it's very public right now in the media is what we do with ethanol. You've had groups like Grover Norquist group saying if you get rid of the ethanol subsidy, that's a tax increase. Where I look at it is we're getting rid of a spending issue. So we're still having this debate of what's considered spending, what's considered a tax increase, and until we get that debate done, we can't move forward with the idea of corporate reform. All right, well, I thank you for your time, and thanks for coming today. Appreciate it.